Ladies and gentlemen, welcome to By the Horns. I'm your host, Ricky Allardyce. By the Horns is a Bitcoin podcast about South Africa. And today we have the great pleasure of speaking to Greg Foss. Greg is a Canadian bond trader with over 3 decades of experience, starting his career in the 1980s and seeing numerous financial crises unfold while managing risk as a bond trader. He's published multiple academic papers and articles on risk management in the credit markets, and more recently has become a strong advocate for Bitcoin. Greg has made significant academic contributions in the Bitcoin space, both in his writings and on many podcast appearances. And today we're going to chat to Greg about why he thinks that sovereign credit risk is the most important metric to pay attention to when evaluating the health of the financial system, and just why he's so bullish on Bitcoin. Greg, welcome to the show.
Oh, thank you so much for having me.
Our pleasure. Greg, how's the weather in Canada?
So we're on the other side of the world, so it's our summertime. I have a golf game scheduled right after this podcast, so let's hope that it's been nice, and hopefully my golf game will match my weather forecast. How about that?
Brilliant. All right, Greg. So I think for us to kick this off, we're going to get quite deep into the weeds on how the bond markets work and credit defaults and all those things. So maybe we can start with just a brief overview of how bond markets function.
So very simply, we need to understand what a bond is, and a bond is and the reason they call it fixed income is because it's a fixed contract generally. Okay, there are floating rate bonds, but let's just assume that bonds are fixed contracts, which the coupon is a fixed is set at issue, and it's fixed. And the bond market is a contract between a lender that can be anywhere from a large pension fund to a central bank of another country, to a small retail investor that lends money to a counterparty on a contractual basis with a different coupon and maturity depending upon the needs of the borrower and the risk qualifications of the borrower, etc. So the key thing to remember is it's no different than going to the bank and getting a loan from your bank, except that these loans trade in an open market. The loans of a bank can also trade in a market, but think of the bond market as being something that is continually recalibrated every day as the price of the bond changes to reflect different financial conditions in the markets. The bond markets are the biggest markets in the world as far as a measure of financial assets that trade. Okay, the real estate market would be bigger, but there's not a homogeneous trading of the real estate market like there is in the bond market. So bonds are liquid. They tend to be thought of as lower risk than equities. They certainly are. I can get into that, some of that subtleties, but the bond is anything from a 1 year to a 30-year, and sometimes even as long as a 100-year obligation from a borrower to their lenders. And that's all you have to understand. It's a fixed contract. It's a contractual obligation that if that contractual obligation is broken, it's due to things like a credit event or a default.
Okay. And so not all bonds are created equal, right? I mean, if there's the market is pricing bonds, in a constant manner, surely some bonds are rated more highly than others.
100%. I mean, I made my career in a segment of the bond market called the junk bond market. Oh my God, the junk bond market. It's got to be a horrible place. A less pejorative term is called high yield. And then the funny thing is, and here's where we'll start getting into finance 101. I was in the junk bond market. I was a junk bond trader. Therefore, I was either a vulture or I was something awful. But then the funny thing is, the same people that wouldn't buy my bonds because I was in this incredibly risky asset class also owned the equity of the same entity. Now, Finance 101, unless the bonds are worth 100 cents on the dollar, the equity is worth zero. There's a priority of claim. Bonds rank as a prior claim in the capital structure to equity. So I'm a junk bond trader. Yes, I am. And you own the equity of the same company. Therefore, you own super junk equity. Okay, we'll call it what it is. You're a super junk equity holder and I'm a junk bond trader. Should there be a price between the two at which you would own some of one and another? And that's what I spent my whole life doing, is basically calculating the various risk levels of a corporate obligation. Now, the big bond markets are the treasury markets where there is no equity per se. It's just the tax base of the country that issues it. But those have the same considerations. You'll have different credit quality of a country like the USA, which is the de facto risk-free borrower in the world, or risk-free pricing in the world. And then you'll have other countries like Canada, which will trade at a premium to the US, provided it's priced in the same currency. So don't confuse yourself with an interest rate in one country that's euros or Deutschmarks versus USA dollars. Always go to the USA market and look at where Canada, priced in US dollars, trades relative to the US Treasury. Same thing for South Africa, same thing for Argentina. Remove a currency consideration from it and look at the different yields in that same currency, and you'll get a measure of what the market thinks the various levels of risk are.
So when we talking about like South Africa, most South Africans are intimately aware of this, but we were downgraded to junk status fairly recently. And that obviously implies there's a higher risk associated with the bond. So therefore there should theoretically be a higher yield associated with it, versus bonds that are less risky. Am I correct in my assumption?
Well, 100%. So, again, if you looked at where South Africa trades in US dollars and compared that to the US Treasury, I wasn't aware that it got downgraded, I guess, but let's say it's a double B credit. The spread for a double B credit in sovereigns would probably be around 200 basis points. I'm guessing, I haven't looked at it, but that means 2% higher for the same term. So let's say in the US right now, US 10 years is in US dollars, US 10 years is 125. South African 10-year US dollar denominated debt would trade at 3.25%, using that 200 basis point spread differential between the two countries.
Got you. And then, so there's a difference obviously between sovereign bonds, so like South Africa, Canada, the USA, and then corporate bonds, right? So corporate obviously is, companies can raise capital through issuing bonds, is right, well?
Correct. So, all of them are raising capital. Let's be clear about that. Some of them, though, sovereigns have the ability to tax, whereas a company does not. What do they have, though? They have the ability to sell products and generate free cash flow, as a business does. And remember, though, that the bond has a priority of claim in a corporate structure. Let's take a good, everyone always talks about the bad things that can happen to bonds. Here's something that happens sometimes with bonds. You lend to a company at a 5% coupon, let's just say, and that spread over treasuries was 400 basis points. And let's take the term out, but just assume, it doesn't matter if it's a 5-year or 10-year maturity. And that company was obviously a risky company, because 400 basis points is necessary to attract capital to that corporation, versus the same lender saying, hey, you know what, I'll just put my money in the US Treasury of the same maturity. I won't get nearly as high a yield, but I'm more comfortable in the Treasury. But let's say they put the money in this risky company, and that 5% coupon is the contractual obligation. And that company, though, starts really doing well. Like their free cash flow comes in much stronger than anticipated. Earnings, free cash flow and earnings are correlated, obviously. At the end of the day, you would see the equity price go higher on that stock, because price earnings multiple and all that, revenues exceeding expectations. Well, what happens in the bond? The company doesn't go out and say, well, you guys lent to me at a 5%, but I'm actually a lower risk now because I've exceeded expectations. Can I cut my coupon? the bondholder the lender will say, screw that. I took the risk. It's not asymmetric. If you went in the other direction, it's not like we could increase your coupon. So then what happens? The price of that bond rises to reflect the better cash flows. In other words, the yield comes down on the bond. Everything else being equal, the yield spread on the bond narrows. And that's a reflection in the market of a company that has exceeded their original expectations. The flip side is, what if they start, crapping the bed? Sorry for your audience if I'm not allowed to swear, but they soil the sheets. Let's say it's not like they turn around and say, oh, well, you were going to increase that coupon from 5% to 6%. No, what happens is that coupon is still 5%, but people who paid 100 cents on the dollar for the bond would say, geez, it's no longer worth 100 cents on the dollar. Maybe it's only worth 90 cents now. And that's why never forget, your audience, that bonds always trade for a price. They trade for a price. You can use the yield to back out what that price is, but never forget that a contract always settles on price, and those prices reflect the differing expectations in the market.
So there's those two things to always bear in mind with bonds. That it's the price of the bond and the yield of the bond, right? And if price of the bond goes up, yields come down, and if yields go up, then price comes down, right?
Everything else being equal, correct. And then you could even turn around and say, what if the credit quality though changes, meaning it became more risky? Then the market demands a higher yield to own that bond. Everything else being equal means the price goes down de facto, because what is a yield on a bond? It's nothing more than an internal rate of return, IRR calculation. Well, if something gets more risky, as we learned in Finance 101, you need a higher IRR to own that bond. So yeah, let's just make the math easy. That used to be a 5% yield I needed. Now I need 8% yield. Well, that's 300 basis points more. And I'm going to run through some quick math for you in my head, but let's say it was a 10-year bond. That 10-year bond has what's called an 8-year duration. A 300 basis points increase in the requirement will knock about $25 off the price of the bond. Hey, this is exciting. Okay. I love being short a bond that I shorted at 100 cents on the dollar and is now trading at 75 cents on the dollar. This is where you get your, it's sort of an equity component that could, an equity type of mentality that could trade for bonds. So again, never forget, a bond trades for a price. How do you arrive at that price? It's an IRR consideration. What do you usually start with? You usually start with the risk-free or the quasi-risk-free rate, which tends to be US Treasuries. And you add on incremental layers of required return to compensate you for risk.
Got you. So we're gonna circle back to the risk-free rates of the US Treasury a little bit later on in the discussion, because things get really interesting there. But so we kind of have a good understanding of how the bond markets function now. But now, what is the interplay between bond markets and the equity markets? So when people think of financial markets, they typically just think about the stock market. But you were saying earlier the bond markets is much bigger than the equity market. And how do those two interplay?
So that's exactly right. So firstly, the bond market is much bigger. Secondly, the bond market tends to trade what's called OTC, or over the counter. Okay. Whereas equities trade on an exchange. And everyone thinks that because it trades on an exchange, there's higher liquidity in the equity markets because we can see, every price or every trade is disclosed. But the reality is the liquidity in the bond markets is also far higher than the liquidity in the equity markets. So they're bigger, they're more liquid, because trading 50 million worth of bonds is a lot easier than trading $50 million worth of equity. Okay. And then the probably the most important thing to remember is equity markets gets flung around like the tail of a dog when the credit markets go into a tantrum. Why is that? Well, again, we sort of talked about the priority of claim within a capital structure. So again, let's just look at a single company. If the bond price goes from 100 cents on the dollar, we mentioned it could go down to 75 cents on the dollar. What does a bond trader What are his options to hedge? Well, one of the options to hedge that risk of it going even lower in price, ultimately to default, is to short the common stock, right? You can either do that through put options. You can do it by borrowing the stock and actually having an outright short on it. Or you can go to what's called a default insurance market, a CDS, credit default insurance market. And all of these are various hedging mechanisms within the toolkit of a bond trader. Now, just let's focus on the interplay between the equity market and the bond. Well, firstly, on a macro basis, if liquidity is being withdrawn from the system and there is what's called a leverage unwind taking place in the system, which we see regularly. So in my career, I saw 1988, the Latin American debt crisis. In 1998, I saw the long-term capital management. In 2008, I thought the world was ending. All of in the great financial crisis, all of these were liquidity unwinds where the system wanted their cash back. And when the credit market starts to gurgle, you see what happens to equity markets, okay? They really start to puke hard. And that's why you always need to look to the credit markets for warning signals in the pricing of equities. It's nothing more than a risk premium calculation. And if the bond market is increasing their risk concerns, that flows downhill to things that are lower in the capital structure, hence the equity markets.
So that's a really good way for people to think about this, right? Because if you understand that the bond markets actually take priority, and that's where, like you said, shit flows downhill. Like that's where you start, and where you see if things start going wobbly there, you can expect it to accentuate through the system because there's leverage applied throughout the entire system.
Bingo, bingo, bingo.
Got you. Okay, so you just mentioned the great financial crisis of 2008. In 2008, the governments around the world, primarily in South Africa, actually handled it very well, but that's a different story. But in 2008, the US government instituted quantitative easing to avoid the problems that they would have had to face up with, which is basically just printing money, right? And that transferred liabilities from financial institutions like banks onto the balance sheet of central banks, which basically means that central banks have been buying up bonds. Now, that has been driving yields down from 2008 until we're at the position where we are now, where we have many, many bonds, or sovereign bonds around the world trading for negative yields, which is insane. Wasn't thought possible, but here we are. And some are trading near, some are trading below zero, many others are trading near to zero. What do you think reasonably over the long term? Like, what are the ramifications of this, and how does this end?
Well, bonds are only math, right? It's a contractual obligation. So you cannot argue with mathematics. All right. So very simply, when I started trading fixed income in 1988, the 10-year US Treasury traded for double digits, okay? And when I first started trading for my personal account, there was a time when the US Treasury yielded over 15% that I remember in my lifetime, okay? Now, it's basically been a one-way, you call it take the staircase down. So you took the staircase down in yields all the way to just last year, the yield on the 10-year US Treasury went under 1% and bottomed out at about 60 basis points, okay? 0.6 of 1%. Why did yield get to double digits to begin with? Well, in the early 1980s, Paul Volcker, who was chairman of the Fed in the US, was determined to stamp out inflation. And that's how high they raised the Fed funds rate in the US in the early 80s. And since then, inflationary expectations and reported CPI have declined to the point where yields in the market have declined from double digits down to under 1%. So given that bonds are a mathematical calculation and there is no arguing with how much you will get if you hold that bond to maturity. So here's what I'm going to tell you. right now, over the next 10 years, starting today, if you own the US 10-year bond for 10 years, starting today, you will earn 1.25% until maturity per annum. Okay, that's barring the unlikely but not zero possibility event that the US defaults. But let's, for the moment, assume the probability of default on the US is 0. You will get 1.25% per annum with certainty over the next 10 years. Dang. I started my career when it was 15% for 10 years, and now you're getting 1.25%. I'm not too excited about owning a bond personally, and any pension fund who has a target rate of return within their entire portfolio of 8% per annum, yet they have 40% of their allocation in bonds, you're hoping that equities are going to perform almost, with outside of two standard deviations of returns consistently to meet your 8% target. A bond is only a contractual obligation. And the funny thing is, no one has adjusted their target rates of return within pension funds to reflect the fact that 40%, using a 60% equities, 40% bond portfolio, 40% of your bonds are now in something that are yielding almost, as you pointed out, 0. And let's take it one step further. If you actually own something that's negative yielding, it's not longer an asset. It's a liability, you knucklehead. You have turned an asset into a liability. You actually owe money now. God darn, are you effing stupid? Like, you are just you're a moron. Except, it's math, and these people say, well, I have to own it. Okay, if you have to be stupid, go ahead. You are an idiot. Let's admit facts are facts. You're an idiot if you own a negative yielding bond. The only way, they say, well, it's going to be more negative yielding over the price of the or the term of the maturity. Therefore, I'll be able to sell it. Yeah, that's a good one. Come on. How many people are like, I'm always smart enough to get out right before things blow up? It doesn't work, guys. And I wanted to clear up one other thing, Ricky, is basically you said QE. So QE, though, started with things called like programs that were required, because 2008, 2009 really was an ugly time. I actually thought many times taking the train to work that it was over. Like, I really thought it was over. Okay. And so the world was not working. All capital markets were slam door shut, meaning there's no chance that you would raise any new capital for new investment or anything. New issuance was 0. And, capitalism needs new issuance and CapEx and all that. The world was ending. So what did the Fed do? The first thing they do is they started a thing called the TARP, Troubled Asset Relief Program, where they basically bought all of these essentially garbage or toxic fixed income instruments off of the balance sheets of many of the world's largest money center banks and investment banks. And again, that's socializing losses, right? You cannot socialize losses without repercussions. And we are now living the repercussions of socializing these losses. The Fed did the right thing because, as I said, look, the world was ending. But what was the problem that led up to it? It's never properly accounting for problems that occurred prior to that. I mentioned long-term capital management in 1998. This had 2 Nobel Prize winning Nobel laureates, I guess you'd call them, Nobel Prize winners on their team, 2 of them. And they were levered 90 to 1, which meant for every dollar of equity in there, they had 90 times the liability. And they were selling volatility to the street. Okay, they were selling vol to the street. They were 90 times levered. They were selling vol to the street. And they're saying, oh my God, the street's a buyer of vol at over 2 times standard deviation. And then they divulge, yeah, and I based my data on 6 years of standard deviations of vol. You're a Nobel Prize winner and you went 90 to 1 levered on 6 years of data. First of all, we should revoke your goddamn fucking thing. Like, that's embarrassing. And yet they got bailed out by the Fed, right? So they're the first bailout, socializing losses, crony capitalism on Wall Street. You go down 10 years, you hit the wall again. Why? Because you socialized losses the first time. So then in 2008, 2009, same thing happens. This was really ugly, but what was the reason? It was all this subprime mortgage exposure, basically levering up the system, ratings agency arbitrage, all this stuff that is so infantile, but it happens when you lever up returns. The Fed had to step in again. And as you correctly mentioned, eventually all that leverage ends up on the balance sheets of the Fed or the respective central banks. It can't continue, guys. It's only math. It is over mathematically. I cannot say it any other way. It is over. We have kicked the can so far down the road that no matter how fast any of our economies grow, we will never outgrow the debt spiral, DEBT. And Twitter is so beautiful. I don't know if you saw that. They made a song about me, Twitter, the debt spiral, DEBT. It's only mathematics. It's actually a pretty catchy tune. So all I will say is this, I stand by it. It's only math, okay? And it's all come home to roost in the form of a debt spiral. That's very scary, because it essentially means the only way you can solve the debt spiral is by continuing to print more fiat garbage money. And if you continue to print more fiat garbage money, the value of that fiat garbage money will continue to debase. And everyone's like, well, it's okay though, because the value of my house is going up. And then you tell them, hey, fool, your house isn't going up in value. It's the unit of account is going down in value. So measure your house in the price of gold, and you'll realize that over the last 25 years, your house has not gone up as measured in gold. And then you say, well, measure equity returns as a function of unit of account being gold. And you'll also realize that the only returns in equities by and large have been dividend payments. The capital gains have been largely only because the unit of account has been debased. So this is all part of a QE solution. It's not a solution anymore, guys. It's a requirement. They can never stop printing money because of the debt spiral.
So, Greg, I don't know if you watched that Ray Dalio YouTube video where he talks about long-term, short-term debt cycles.
Yes.
And he kind of alludes, so that was in 2013, right? He alludes to the fact that the long-term debt cycle ended in 2008. What's your take on that?
I agree 100%. And the funny thing is, Mr. Dalio, a hugely intelligent man with a very successful risk I'm drawing I was going to call it risk arbitrage, risk parity. Sorry. He has a risk parity strategy where he would balance the holdings of his bonds against equity vol. That strategy works fine as long as interest rates continue to decline. So in 2013, he called it, but interest rates didn't bottom out until 2019, 2020. The funny thing is, Dalio called this debt spiral. He knows what the problem is. I know he said, I'd rather own Bitcoin than a bond. I 100% agree with him on that. But yeah, no, debt is a cycle. And we are in the last innings of a debt cycle. Correct.
Okay.
So Greg, everyone talks about inflation versus deflation. But, what it sounds like to me, what you're saying is that the real elephant in the room is credit risk.
Bingo, but
default risk.
Bingo. It's 100% that. Sorry to jump over you, but so everyone has always traded bonds based on an inflation expectation. That doesn't matter. It's over whether we have inflation or deflation. It is over from a mathematical calculation. The currency is the error term. The currency needs to be printed to solve the debt spiral. So I'll argue then, don't worry about inflation or deflation, you bond fools. Start looking at the credit quality of the underlying sovereign, not the inflation expectations in that country. Just look to the credit quality and the market's assessment of credit quality of that nation. And I'll answer the question you were going to ask me. You're going to say, well, then, Greg, how do we look at that? And I'm going to say, great question, Brandon and Ricky. How do you look at that? And you look at that in something called the credit default swap market. It's the last standing pure risk measurement market that is not being bullied around by an elephant in the room like the Fed purchasing $120 billion worth of bonds each month. Okay. There are no signals in the bond market anymore. Like, what a garbage thing, Powell, yesterday? Well, we're finding it hard to get any real indications from the bond market, and we're not sure why that is. Hey, don't lie to your public any longer. You're a liar. You know that when you have an elephant in the room purchasing $120 billion of securities out of your own market, it can't possibly be giving you the proper signal. But he's going to pretend that, we're not sure what the bond market signals are. I've never heard such garbage in my life, and it's downright criminal, quite honestly, that he tries to continue to snow the general public on this. Okay, if you put a lie detector test on him, I'd love to see the lie detector test when he says false statements or outright lies, like he just said. That's what it is. It's outright lying, because surely he is smart enough to know what he is saying. And if he isn't, then we really have big problems.
Yeah, and then and he's trying to redefine what transitory means as well now.
Dude, it's basically a name. It's nothing. He has expectations. It's just such a game that's gone so woefully wrong. Everybody that's smart enough knows the mathematics, but no one's allowed to say anything, because they realize if they give up the ghost on what the math really is, people will look at that dollar bill and say, this dollar bill, US greenback, everyone wanted it. And then they'll realize it's nothing but a liability. It's nothing but, hey, I don't even want this fucking thing. Like, get me off of this stupid thing called a dollar bill, US dollar bill. And then it even gets worse as the various countries that are lower credit quality than the US, the spiral can accelerate quicker. And let me take this chance to apologize to your listeners for my F-bomb.
No, you're all good.
I only say it because I'm so absolutely disgusted with the lying that takes place from people of my generation. Okay, so look, I'm 58 years old. I've been in the markets for over 30 years. I don't actually think I could get on stage and lie to a population like that. It's just so despicable. So I need to make amends for my generation, which may be the most selfish generation ever put on earth. And that's the boomer generation. Okay. These guys are outright liars. They are outright thieving, stealing from the general population. And it's disgraceful.
I'm just glad it's not me cussing first.
Yeah, so please don't worry about swearing. I think we swear way worse than you, and we wouldn't be Bitcoiners if we didn't swear, right? We're all
I guess so. You know what we all share is a desire to make to right these wrongs, and sometimes you get a little intense about it. Believe it or not, I have tremendous amount of hope. We haven't even touched on Bitcoin, but it is the thing that does give me hope. Why? Well, first of all, you don't have to worry about any human being, because Bitcoin is only math and code, and there is no one who owns it, no one who controls it. And in my opinion, it is the most beautiful technology I've ever encountered in 30 years of trading risk. The simple thing is I can send money or store a value anywhere in the world, and it settles in 10 minutes. Okay. I've sent it to South Africa. No, sorry. I was going to say I've sent it to New Zealand. I've sent it to the US on many times. I just sent some to Mexico or to my friends in El Salvador. Okay. My research paper was translated into Spanish by a group working in El Salvador. And it's so exciting to be part of this. And imagine if I had to pay them using Canadian fiat currency and wire them money through the SWIFT system. First of all, it doesn't take 10 minutes. It takes over 10 days. Secondly, there's always a chance it doesn't get there because there's been some routing error. Third, and most importantly, they think it's their money you're sending, not yours. They make it feel like, are you sure you want to send this money, Mr. Foss? And do you know your client? And and you just sit back and you go, you guys are such assholes, okay? To the commercial banking system as it exists right now.
Yeah. Yeah,
I was helping someone who was also a boomer the other day, and as soon as I scanned the QR code and they saw this Bitcoin, get in their wallet, like you just see their eyes.
Hey.
It's like magic.
Even better than that, Brandon, is you take them and show them the blockchain in action. Okay. So if you guys have ever gone to a place called tradeblock.com where you see all the transactions flashing across the world, that's what sold me as an engineer. Okay. I said, what? So first of all, let's take a little step back on where I came from. So I was a McGill engineer. That's a university in Montreal, Canada. I was there for 4 years, and then I went on and did a business degree in the US for 2 years. And I came back and I worked in Canada in financial engineering. So I always still have this gut appreciation for engineering. Mathematics and engineering are closely intertwined. So I'm fairly comfortable with mathematics. When you're a bond trader, you need to understand math really quickly. You need to do it in your head on the fly. You don't even have a calculator sometimes because a trade is being done on the phone and you're like, okay, you're done. Basically, you have to beat the other guy to the trade. So I've always been comfortable with mathematics, all this stuff, engineer. But what did I think about Bitcoin when I first heard about it? I thought, like everyone does, it's just a Ponzi scheme. But I just said I was intellectually curious. I said, well, let me do a bit more work. And the guy that was introducing it to me, he said, well, here's the blockchain in action. And I see this beautiful thing working. As an engineer, I look at this and I'm like, are you kidding me? This is no Ponzi. This is the most beautiful thing I've ever seen. And by the way, I've always thought Fiat was the Ponzi. Now this is the solution. So it was a quick sort of summary of me going from engineer to financial engineer back to looking at blockchain as being a solution and then visually seeing this in action. Let me tell you guys, it's the best technology, but it most importantly offers solutions to the less fortunate and less privileged people in the world. I mean, look, I'm privileged. Okay. I live in a G7 nation. I've done well in life in terms of earning money. I worked hard for it. No one gave me the money. I mean, I worked darn hard and there were plenty of sleepless nights. But at the end of the day, the biggest thing about Bitcoin that makes me the most excited is it levels the playing field. When the Fed does all their crappy, stupid programs and pretend stuff like we're helping out the less fortunate, that is such garbage. They are actually penalizing the less fortunate all the time. Yeah. But what Bitcoin does is it actually levels that playing field. So, I'm not holier than thou. I'm a capitalist with a heart. There's no question. I like helping the less fortunate. And there are times when, yes, absolutely, the Fed programs were necessary, but stop. And it's too late. We can't stop now. But there was a time we could have stopped, but you don't get another 4 years in office if you stop, sending out paychecks to people that don't understand the consequences of getting those printed money paychecks.
Yeah, 100%. And the beautiful thing about Bitcoin is there's no counterparty risk. And unlike even with bonds, like and governments, like there's still a counterparty there, and this is why they can default.
So
with Bitcoin, no one can default, right?
So here's the neat thing. So let's walk through what was happening in 2007, 2008, 2009. The market for credit was signaling problems in the system. There was an event in the summer of 2007. You may or may not have remembered it, and maybe you don't even know who Jim Cramer is in South Africa. But Jim Cramer is this commentary on.
I know. We know who Cramer is.
All right, so he gets on. I still remember it so vividly. In the summer of 2007, he gets on a warm, sunny afternoon. In Canada, anyway, it was warm and sunny. I think it was in New York too. And he gets on and he just lays into the Fed. They have no idea what's going on out there. They are absolutely retarded. They, again, no idea. And the lady that was interviewing with him, who was like, Cramer, stop. And I think Jim actually, the veins in his forehead were popping out and he was very scared. So the Fed may have heard Cramer's rant and they ended up cutting rates. Because that's what they always do. Well, you cut rates to relieve pressures of the system, increase liquidity. And the equity markets tended to stabilize, but the credit markets never did, okay? The credit markets just said, this is nothing. This is not even close to what needs to happen. the markets were signaling distress, actually continued to signal distress on names like Bear Stearns and Lehman Brothers. So if we looked at those credit default swap or insurance policies, let's say you had exposure to Lehman Brothers and you needed to ensure, you wanted to help ensure that your exposure was mitigated. So you bought insurance on Lehman Brothers. What if you had bought the insurance on Lehman Brothers from Bear Stearns? And all of a sudden, Bear Stearns is going down. You're like, oh my God, I need to buy insurance on my insurance. Okay. This is what's called contagion. The whole system was basically tumbling like dominoes. And that's what's beautiful about Bitcoin, as you correctly pointed out. There is no counterparty that you have to worry about. Okay. There's no risk that the person that sold you or that owes you this money will not be able to make good on it, either from an insurance policy or from a contractual obligation like a bond. Now, the insurance policy is also a contractual obligation. I don't want to get too granular, but at the end of the day, you're totally right. The financial system is flush with counterparty risk, and that tends to what cause things like contagion. Whereas Bitcoin, no, there's no counterparty risk. It exists on a decentralized blockchain. We know all its beautiful attributes. I'm sure you guys have done a great job of educating your listeners on that front. But the counterparty risk argument is something that's so substantial. Because if you own it, you own it. And you don't have to worry about it not settling. It's a distributed ledger that's verifiable. You guys know. So no counterparty risk is a huge attribute for anyone who's traded risk in the financial markets.
And Greg, talking about financial institutions, I think we're all very excited about institutions entering the Bitcoin space. But I think being a Bitcoin for a while, we tend to not trust a lot of people. There's a lot of good things that'll probably happen from that price-wise, but what do you think the bad things will happen? What are the risks with these institutions coming in? How will they game people? Because they also want to make money.
Yeah, a great question. So first of all, let's look at the use case before we worry about whether the number goes up and going up because of demand. So a real life use case is I was lucky enough to give a presentation at the Bitcoin Miami conference. And prior to that, I was introduced to a group of kids that seeked me out, and they were from Guatemala, and they were developing an exchange in Guatemala to trade Bitcoin, to bring Bitcoin to the population of Guatemala. And they wanted to do an experiment in Guatemala that reflected El Salvador's Bitcoin beach. And so they wanted to bring Bitcoin to El Salvador. Why? To Guatemala. Why? Well, first of all, because there's a large portion of the population of Guatemala is unbanked. Okay, they don't have a bank account. A large portion of them are getting raped by remittance fees from Guatemalans that go to the United States as immigrant workers, and then using Western Union to remit their money back to their home country. There's about a 20% fee on that. Okay, so they understood all this. So I brought this up on stage, and I said they want to do Bitcoin Lake, much like El Salvador, Bitcoin Beach. Lo and behold, 6 hours later, Jack Mallers is on the same stage, and he divulges that they onboarded an entire country called El Salvador. Okay. Well, this is amazing for my buddies at Guatemala, because Guatemala is less than a 3-hour drive to El Salvador. These guys are now helping implement the Lightning Network in El Salvador. Okay, these guys in Guatemala have 6 or 7 of the top Lightning programmers in the world working with them, and there's only about 100 of them. And these are going to change the world, because you saw the math on El Salvador. Just by using the Lightning Network to remit payments back to El Salvador from working immigrants, they'll increase their GDP by 4% annually. Okay, that's how much fees Western Union and money transfer agents were taking out of the pockets of El Salvadorians. So those are the use products that I see. And then let's be honest. So we're all capitalists. Why do I love Bitcoin from a store of value perspective? Well, I love it because A lot of people will say it's digital gold. I'll say, no, it's actually better. It's called digital energy. And I believe Bitcoin is digital energy. And I believe that with all the, cap supply and everything, that the number goes up. So the number is going to go up because it's a beautiful technology that has a use case. And the number is also going to go up because institutions are going to say, why do I own bonds? Like bonds, we just ran through this. Bonds are for fools right now, okay? And that includes retail investors. If you own a bunch of bonds, I'm going to ask you whether you passed grade 11 math. No, we have to be more. This is probably first year, second year university math, because you have to understand first derivatives and second derivatives for bond pricing. But the point is, if you own bonds in your portfolio, whether you're an institution or you're a retail investor, guys, you need to really do some serious navel gazing, because you really don't understand the true risks you're taking. And then they'll say, well, where should I put the money? And the answer sometimes comes back. In my own case, personally, it comes back in flying colors. You better own a store of value that is the perfect technology that's ever been developed by man to store value, store energy, and it's called Bitcoin. So, Brandon, long way of answering your question. What happens when the institutions get involved? Well, they have a fiduciary responsibility to their unit holders to try and make money. And if they do the math properly, they'll realize that the asymmetric trade opportunity in Bitcoin, and I'm going to use my words here, it's the best trade I've ever seen in 32 years from a risk reward perspective. Why is that? Because it's got such a long tail asymmetric potential return that you need to own some. So what does that mean? Well, you had the use case that we talked about, but it also means that there's institutions whose job it is to store value. They may look at it as an investment product, and they are, and they're coming in. And with a fixed supply and more demand, well, economics 101, we know where the price generally goes. And my targets, and we could run through those if you want, makes the current trading price of Bitcoin a rounding error. I frequently say, don't overthink it. At the current price of Bitcoin is a rounding error compared to where it could go in price.
Yeah, absolutely. But so I just want to circle back to the fear porn again, just for a second, because I think this is a really important thing for people to understand. People always seem to think they have more time. Whenever you speak to them about financial crisis and accumulating Bitcoin, they're always like, I'll get some Bitcoin. Life happens. They don't do it. But just when we think about a crisis happening, and you were there in 2008, sitting in the chair, managing risk when it was happening, just how fast do these credit markets unwind when there's a crisis? And then how fast is that contagion spread? Well,
it gets faster and faster each successive time. So in 2008, 2009, it unraveled over a period of it was almost 2 years, right? And then what happened in the COVID crisis? It unraveled in under 2 months. And the result was the same. The Fed had to come in and rescue the system. Now the Fed, obviously has, they're much more sensitive to things these days. They know they have to be. But it's my opinion that the credit markets will continue to unravel faster and faster as each successive crisis happens. The reality is we probably only have one more crisis in us before it really could end. I'm not in a crowded theater yelling fire here. Okay. I'm just trying to get people to analyze risk versus return and various instruments they need to hold as protection against the possibility of these events. I do not want the fiat system to fail overnight.
Yeah,
I'm certain it will fail over time, but I don't want it to happen all at once. Okay, there will be two parallel systems that exist. One will be a fiat system that you need to use as your checking account, and one will be a Bitcoin system that you should use as your savings account. And don't confuse the two, and manage those risks according to your ability to save for the future. And ultimately, the best device that I've ever seen to save for the future is Bitcoin. Doesn't mean you don't own equities. It does mean, in my opinion, you own very few bonds because bonds are a losing proposition. But it doesn't mean you don't own real estate. It doesn't mean you don't own gold. It just means you own hard assets that will maintain their value over time relative to a fiat currency and contracts in a fiat currency that are 100% certain to debase. Okay. Again, it's only mathematics. And every time I say that, I start thinking of that video in the back of my head. It's only mathematics. It's only mathematics. Anyway, so sorry for your listeners. It was quite a funny video on Twitter that was one of the Bitcoin guys made of me. So point is, guys, yeah, please understand that it's only math. This is a risk, probabilities, expected value outcomes, because that's all life ever is balancing the probability analysis of various things occurring and protecting yourself accordingly.
Yeah. But so now if we look at the US market, for example, let's say there's a crisis that starts out in Wall Street and with the Fed, how does that contagion spread? Because the US market's not going to go down first. You know, it's the biggest, deepest, most liquid.
No. So go ahead. Sorry.
How does that play? How does that interact with small nations? Because obviously we South African, we're part of the G20, but I mean we are not in a good place from a debt to GDP perspective, and our credit risk is significant. And like, how does that spill over into small nations? And
so it's not going to happen at the U.S. first, right? It is not. It's going to happen, and so I just learned something. I guess I didn't realize that South Africa was G20, which thank you, because. I knew Argentina was, and by the same token,
barely there by the skin of our teeth.
Here's the funny thing: Argentina is, and they've been a serial defaulter in my career. They've defaulted 3 times in my career. Yeah. This is crazy, and people continue to lend them money. Like, you cannot possibly be that stupid, can you? Well, I guess you can. So South Africa. So where will it unravel first? All fiats fail. Okay, Voltaire said that all fiats will fail. It's most likely that the last fiat to fail will be the US dollar, okay? Which means that Canada will fail before the US does. And it's according to the credit default swap market, that's an open market calibration of what countries are most likely to fail first. South Africa is going to fail before Canada. Argentina will fail before Canada, but Canada, in my opinion, is now at risk of being the first G7 nation that will fail. That's all the market's saying. It's not Foss out there saying Canada's on fire, Canada's going to fail. I'm just reading markets. I'm telling you what the default swap market is telling you. So even though Canada has maintained this pristine credit rating by S&P of AAA, the default swap market's saying vastly different things. All right. Now, it's not as if this fire is imminent. It just means that the risk of Canada is higher than that rating of subjective rating that's applied by a credit rating agency. And here's the funny thing. Those credit rating agencies become circular as well, right? Because if they finally downgrade Canada because they realize that, they're behind the curve a little bit, then the market says, oh my God, they just got downgraded. And then, it accelerates the spiral there. So coming back to your question is, the USA will be impacted by this, meaning if there's a fire in the lesser G20 countries, it will be pushed to the United States, and the riskiness of the United States will be perceived to increase. But I'm certain that the event will happen in the other countries before the default event happens in the United States.
Yeah. And I mean, Canada's in a unique position because they're the only country out of the G7 that hasn't got like a massive amount of liquidity with the central bank. I mean, all the rest, the US obviously got the Fed, which is the world reserve currency, and the rest of the G7 countries have the euro. And Canada is sitting there by itself with the Canadian dollar.
Well, don't forget, so the Brits don't have the euro anymore, right? But we're not even close to being as good, as large an economy as Britain. So, look, yes, you're totally right. Yes, I'm a proud Canadian. Yes, do I wish that Canada would embrace an alternative? Yes. I'm in the energy business. Yes, Bitcoin is digital energy. Yes, Canada has a lot of natural resource energy. If Canada could get it through their thick heads about what a beautiful technology Bitcoin is to take advantage of our natural resource energy, hey man, we could actually change that narrative where Canada becomes an improving credit, because we sold all our gold. Canada sold all our gold out of our reserves. Haiti has more gold on their central bank balance sheet than Canada does. And by the way, we have quite a few mining companies in Canada, gold mining. We're not like South Africa, but we're still up there. It's just retarded. It's retarded what we've done. That's what you get when you hire a drama teacher as a Oops, sorry, did I say that about Trudeau? Okay, let's not. But the point is, the politicians are all fools. Okay, there are certain politicians that get it, and that gives me hope that. But the current band of idiots deserve to be, tried and quartered for their ineptitude of managing. Trudeau famously said, the budget will balance itself. That's Canada's prime minister. If he had been a CEO of a company that uttered that lame thing, the company's stock would get shredded and he'd be out of a job. But in Canada, no, we embrace him because he's a pretty boy. Anyway, I better be careful what I say. So,
Greg, what's your take on altcoins and what's happening in the markets?
I only focus on Bitcoin, guys. My bandwidth is not large enough to. I'm still learning about Bitcoin. Bitcoin solves everything that I need to be solved with the failing fiat system. None of the other coins do that. Bitcoin has a tremendous lead. It's the most powerful computer system in the world. You could come with a new Bitcoin that says this, but you have no nodes, you have no market value. And by the way, who needs something better than or something? It already exists. Don't overthink this. Don't try and invent another rocket. You already have the rocket there. Don't overthink this. And then there's other things that are problems with the altcoins. I'll just leave you with this thought. Bitcoin is the only truly decentralized blockchain. Yeah. What is a blockchain used for? Decentralization. What any other platform that claims they are decentralized and using a blockchain, but is actually centralized, could be much more efficient if they actually used a database rather than a blockchain. Okay. Funny thing is, though, you can sell a lot of crap to people based on these false claims. Focus on Bitcoin. I'm going to go out and say this. There is, in my opinion, a very good chance that the other coins and other apps that are being touted for on other altcoins, they are a test net for layer 3 applications for Bitcoin. Okay, think about that for a sec. Yeah. All this other stuff, the ideas maybe not be wrong. It's just the platform is wrong. Okay. Yep. Remember, it all revolves around decentralization and true decentralization.
Absolutely. Well, decentralization and security, like
hand in hand. But that's what the power of the computer network is, right? I mean, look, you can say, I got a better coin than Bitcoin, but it's run between Brandon's computer, Ricky's computer, and my computer. Who the hell is going to say that that's secure like Bitcoin is? Like, just stop thinking about it. And I want to hit, because I got to leave in about 10 minutes. And there's the subject I need to hit on with your listeners is this. Don't overthink the value of Bitcoin right now versus where it can go. Okay. And this is why we need to play this probability distribution. I believe that the price of Bitcoin can easily exceed $2 million per Bitcoin. I used my research to value what Bitcoin would be intrinsically valued at today if we use the credit default swap markets to value Bitcoin as an anti-fiat. And in that research, I came out with a number that's approximately $150,000 per Bitcoin just today. That's in the event of stable markets without spreads that are exploding. The intrinsic value would increase of Bitcoin as those credit spreads were imploding. But just today, it's worth $150,000 per coin. Okay. It's trading. Where is it trading? 40,000 US something. Well, right there, you're supposed to be buying it with your eyes closed because it's stupid cheap relative to any other insurance you can get regarding the inevitability of fiat default. But let's take it one step further. we talked about Bitcoin being digital energy. Doesn't it make sense if you're Russia that you don't really want to get paid in US dollars for your valuable natural resources? Wouldn't you rather get paid in digital energy for your natural energy resources? So I believe that within the next 10 years, oil and natural gas will become priced in Bitcoin. And when that happens, it's my belief that at that point, the US dollar will be supplanted as reserve asset in the world, not reserve currency, just reserve asset. And Bitcoin will become the de facto reserve asset in the world. And if that happens, which I believe is highly likely, then the value of Bitcoin compared to global financial assets, which right now is minuscule, will increase substantially. I could run through the math on how I think it gets to $2 million per coin, but you can read that in my paper or you can see it on Twitter. The point is very simple, ladies and gentlemen. This is the best asymmetric return trade I have ever seen because the upside is so extraordinary, okay? Bonds are guaranteed to debase. Your currency is guaranteed to debase, and equities barely keep pace with the debasement, as we've proven. But Bitcoin is agnostic to all of that. It is a purely the best technology and the best technological store of value ever created by man, backed by the world's strongest computer network. So come back to this altcoin thing. You know, there could be some other good ideas and NFTs for art and everything. Yeah, those make sense, but make sure they're on a chain that is truly decentralized. Otherwise, someone can rug pull you.
Absolutely. Amen to that. On that bombshell, I think we're going to probably leave it there. Greg, thank you so much for your time. This has been a fantastic discussion. We really enjoyed it. Tell me, where can people, if they want to read more of your work, then read the papers we've spoken about, where can they find you?
Sure. So I've discovered social media. Look out, world, because my social media used to revolve around a Bloomberg machine. Okay. I've discovered Twitter. I'm at Foss, Greg Foss. So FOSS, GREG, FOSS. I'm open to lots of questions. I love South Africa. I mentioned to you guys before that my absolutely next door neighbor is South African. Sorry that we imported him from your country, but Canada's better off for it. So I'm out there because I believe in the future for my children. This is so important for the future of not just my children, but the children of the world, including, and I don't say this lightly, including the children of countries like yourselves whose less privilege are voicing their discontent with the system. And I don't blame a lot of these. I do blame the actions that they're taking, but I don't blame the emotion and why they're doing it. Okay. So, I'm trying to help. Why am I trying to help? Because I believe I've been in a unique position where I've experienced a lot of stuff that most other people haven't experienced, including all these academics that claim, like Steve Hanke, that he understands. Mr. Hanke has never sat in a risk chair in his whole life, okay? He sat in a cushy endowed chair at a half-rate university. Used to be a full-rate university, but now it's only a half-rate university, in my opinion. And one of my best buddies graduated from Johns Hopkins. So, sorry, Jamie, but I'm cutting down your old alma mater because you have a stupid-ass professor there that either is so conflicted and understands what he's saying is garbage, or actually doesn't understand what he's saying is garbage and therefore should not be a professor, okay? Therein lies the truth. You need to do your own research. You need to realize that people like Peter Schiff and Steve Hanke are either so conflicted or so stupid, you shouldn't be listening to them, okay? And that's the danger. We need to get the word out, guys. It's time to call it out, okay? You got to tell the truth. And I'll summarize it with this. Bitcoin is hope, and also Bitcoin is truth. Seek out the truth. Do your own homework. Thank you for having me, and let's hope I can at least hit 1 or 2 pars on my golf round this afternoon, okay?
We hope so too. Greg, thank you so much. And guys, if anyone wants to dig a little bit deeper into what Greg's been talking about, his paper is an absolute treasure trove. We'll put it in the show notes so you can read the paper yourself. It covers all of everything we discovered and much more. You guys can download the audio version of this on the podcast. So if you don't want to watch it on YouTube, like a normal person, you can drive in your car and listen to it. We've got a podcast. And go check out Bitvice. We sell Bitcoin. We set you up with your own multi-sig. We only do self-custody. We're setting up a SAT stacker product coming soon. Yeah, that's a wrap from me. Brandon, anything from your side?
Thanks so much for your time, Greg.
My pleasure, boys, and thank you for the work you're doing too. It's going to improve the lives of a lot of people, okay? Because it is, again, hope. So thanks for having me, and I look forward to doing this again sometime if you guys are up for it.
100%, always. Thanks, Greg. Have a good one. And I hope you shoot an eagle.
That won't happen. There's another thing I'm certain of, okay? I'm certain it's only math, and the probability of me shooting an eagle is very, very low. Although it's not zero, is it? Okay, thanks, guys. See you.
Cheers.